Hello everyone and welcome to today's video. So our topic today, we are going to talk about the purpose of financial statements. The purpose of financial statement is to provide a detailed information about the financial performance, financial position, and change in equity position of the organization. The objective of sharing the financial reports is to enable a wide range of users to make well-informed economic decisions. So, the financial reports are intended to be understood by the users who have a reasonable knowledge about accounting and industry dynamic, and also the environment where the organization operates. So we have two types of users of financial statement. The first are the internal users, and the second, the external users. Let's begin by the internal users. The managers and owners review the financial statement in order to take well-informed decisions that can affect the operation of the organization. The external uses of financial statement. We have the prospective investors and shareholders. They require to use financial statement in order to evaluate the benefit of investing in the organization or not. So they frequently use financial statement, and the financial statement form the basis of investment. We also have government entities and tax authorities. They use financial statements in order to calculate the accuracy of taxes and duties to be paid. We also have the bank and the lending institution. They also need to review the financial statement in order to decide whether to extend loan to the company or not. So let's have a look on the accounting policies. Accounting policies refer to the principles used while using these principles at the time of presentation and preparation of financial statement. So there is no single list of the accounting principles or policies that have to be used. As the organization operates in a complex environment, they always have to choose the principles that fit with the organization environment of the company. So let's have a look on some areas where we can encounter the accounting principles. We have the methods of depletion, amortization, and provision. We also have when to evaluate the fixed asset, when to evaluate the inventories. We have to choose the methods, either FIFO or LIFO. So there are also some other areas. So what are the considerations in selection of accounting policies? Major consideration in selection of accounting policies include the prudence, the principle, accounting principles prudence. As per these principles, it is intended that the organization have to make sure that the incomes and profits are not anticipated, and it is advised that all losses, even which are best estimated, we need to make provision. Another principles, it is substance over form. So, as per these principles, all organizations have to decide the accounting treatment of transaction based on substance rather than over the form, the legal form. Let's take, for example, the sales and leaseback transactions have to record after a true understanding of the exact nature of the transaction. And the last principle is materiality. According to this principle, only those events and transactions that are material in nature need to be disclosed in financial reports. So, an item is considered as material when its knowledge has the impact on the business or decision making of the users of financial statements. Let's see now on double entry system. Double entry system is a system that recognizes and records both aspects of transaction. So when we buy something, either our bank will reduce or our cashier will reduce, or the liability, the supplier or vendor, will increase. So let's have also a look on accounts book. Accounts books are the book that helps us to record all transactions that taken place in the company. So according to double entry system, we have two main accounts book. We have the journal and ledger. The journal entry is the original book of entry, as it records the transaction when it takes place. So in the organization where the business are quite big, we can subdivide the journal in subsidiary journal, sales journal, cash journal, and also on. Cash journal is also the journal of original entry, as it records all monetary transactions. So the ledger summarize according to that entry system. All similar transactions have to be recorded in one account book called ledger. So this summarized and provide the detail on one similar account that have been recorded to the journal entry. So we end at this step today, and I hope this video was helpful for you. Don't forget to subscribe and to share our video with your friends, especially also with the members of Luiza Initiative, Luiza Dibadori Initiative. Thank you all for watching. See you soon. Goodbye.